$74.6 billion. That's how much the Federal Reserve injected into the banking system on December 31st, 2025. Not through normal operations, not through scheduled facilities, through the Standing Repo Facility in a single day, the largest overnight liquidity injection in American history. The official explanation: year-end liquidity management, routine adjustments. Nothing to see here. But here's what they didn't mention in the data release. This wasn't routine. This was desperation. Because 61 days earlier, on December 1st, the Federal Reserve had officially ended quantitative tightening. After draining $2.4 trillion from the financial system since June 2022, they simply stopped. The balance sheet froze at $6.57 trillion. QT was dead, and the market knew what that meant. The experiment had failed. For 3.5 years, the Fed had been removing money from the system, letting Treasury bonds mature without reinvesting, allowing mortgage-backed securities to roll off the balance sheet. Month after month, $95 billion drained from the financial system. They called it normalization. They called it reducing the bloated pandemic-era balance sheet. They said it was working. It wasn't working. By October 2025, the warning lights were flashing red across every corner of the financial system. Bank reserves had collapsed below $3 trillion for the first time since 2019. The Secured Overnight Financing Rate, SOFR, the benchmark that determines how much banks pay to borrow from each other overnight, had spiked to 5.34%. That's above the Fed's target range of 5.25 to 5.50%. When SOFR breaks out of the Fed's control band, it means one thing: the system is running out of money. On October 29th, the Federal Reserve called an emergency meeting, not to cut rates, not to announce policy changes, to end QT. The official statement used careful language. The committee decided to conclude the reduction of securities holdings on December the 1st. Translation: we're stopping before something breaks. But something had already broken. They just weren't saying it out loud. The overnight reverse repo facility, the Fed's overflow valve for excess liquidity, had been draining for months. In 2022, it held $2.5 trillion in parked cash from money market funds. By December 2025, it was near zero. That buffer was gone. Every dollar of stress in the system now hit the banks directly. No cushion, no backup, just raw exposure to liquidity pressure. And the pressure was building. The Standing Repo Facility, originally designed as an emergency backstop, had become a permanent lifeline. In September 2019, when overnight repo rates exploded during the last liquidity crisis, the Fed created this facility as a safety valve. Banks and primary dealers could borrow cash from the Fed by pledging Treasury securities and mortgage-backed securities as collateral. It was supposed to be rarely used, a nuclear option for extreme circumstances. By December 2025, it was being used every single day. On October 31st, the facility recorded an $18.5 billion draw. At the time, that was shocking. Banks borrowing that much in a single day meant funding markets were seizing up. But it got worse. November brought daily usage in the 10 to 15 billion range. December saw spikes of 20 billion, 30 billion, 40 billion, and then came December 31st. $74.6 billion, the single largest repo operation in the Fed's history, larger than any day during the 2008 financial crisis, larger than March 2020 when the pandemic hit, larger than September 2019 when overnight rates went vertical. This was the new record, and it happened on the last trading day of the year, when most Americans were celebrating New Year's Eve. The timing wasn't coincidental. Year-end is when banks face their tightest liquidity constraints. Regulatory reporting requirements force them to shrink their balance sheets temporarily. Lending freezes up. Cash becomes scarce. It happens every year, but not like this. Not $74 billion in a single day. The collateral breakdown tells the story. $31.5 billion in Treasury securities, $43.1 billion in mortgage-backed securities. Banks were pledging everything they had to get cash from the Fed, and the Fed was accepting it all. The next business day, January the 2nd, the facility balance dropped back to $23 billion. Another $51 billion unwound overnight. The crisis had passed. Or so it seemed. Because here's the thing about overnight repos. They're supposed to unwind. That's how they work. Banks borrow for one night, then pay it back the next day. The fact that $74 billion came back doesn't mean the problem disappeared. It means the problem was solved by emergency Fed lending. Now ask yourself this. If the system needed $74 billion in emergency cash on December 31st, what happens the next time liquidity tightens? What happens when tax payments come due in April? What happens during the next quarter end? What happens if a major bank fails a stress test? The answer is already written in the data. The Fed will print more money because QT is dead and there's no going back. But the story doesn't end there. Because while the Fed was fighting a liquidity crisis in the banking system, something else was breaking, something far more dangerous, something that would expose the entire foundation of the modern financial system. The silver market was imploding. On January 1st, 2026, while COMEX silver futures showed $71.50 per ounce on trading screens across the world, physical bullion dealers in Tokyo and Dubai were selling silver when they could find inventory at $130 per ounce. Let me repeat that. An 80% premium for physical silver over the official paper price. This has never happened before in modern markets. Gold occasionally sees 5 to 10% premiums during supply crunches. Silver sometimes trades at modest premiums in specific regions, but an 80% systematic decoupling between paper and physical prices across an entire continent. That's not a premium. That's a market failure. The numbers don't lie. According to data from the London Bullion Market Association and CME Group, registered silver inventories in Western vaults have plummeted by over 70% since 2020. COMEX-eligible inventory peaked at 342 million ounces on October 3, 2025. By January 7, 2026, it had fallen to 318.85 million ounces. That's a 6.85% drop in just 3 months. And registered inventory, the metal actually available for delivery against futures contracts, was even tighter. In December alone, COMEX faced delivery demand of nearly 65 million ounces. That's a volume the exchange struggled to fulfill. Reports surfaced of cash-only settlements. Buyers demanding physical metal were being offered cash instead. The exchange was running out of silver. And then China made its move. On January 1st, 2026, precisely when the physical paper decoupling accelerated, China implemented the most aggressive precious metals export controls since rare earth restrictions. Beijing reclassified silver from an ordinary commodity to a strategic resource subject to government licensing. Only 44 companies received authorization to export silver over 2026 and 2027. 44 companies to control the entire global flow. China refines 60 to 70% of the world's silver. That's approximately 121 million ounces of annual exports, and now every single ounce requires government approval. The Chinese Communist Party effectively ring-fenced nearly 65% of global refined silver supply for domestic use. Western markets panicked. Industrial users in the semiconductor sector, electric vehicle manufacturers, solar panel producers, all scrambling to secure physical metal at any cost. Because here's the thing about silver, it's not optional. There is no substitute for silver's conductivity in high-end AI chips. There's no replacement for silver in solar cells. Unlike gold, which serves primarily as a store of value, silver is essential to modern technology. When supply disappears, production stops. And supply was disappearing. Shanghai gold exchange premiums exceeded $8 per ounce above COMEX prices throughout late December. Buyers in China were offering foreign suppliers $8 premiums to secure metal. Indian buyers offered $5. In Dubai, Pamp Suisse 1-ounce silver bars were listed at 470.83 Emirati dirhams. That's approximately $128, an 82% premium over COMEX. The first CME delivery report of 2026 revealed something extraordinary. JPMorgan Chase, the largest bullion bank in the world, was aggressively standing for maximum physical delivery, not closing positions, not rolling contracts forward, taking actual metal, moving it into storage, a complete strategic reversal from their historical short position. Over 1,000 contracts in a single day went to actual delivery. Sellers providing real silver bars from approved vaults. Buyers taking ownership. This is not how futures markets normally work. Most traders close or roll positions before expiration to avoid physical handling. But in January 2026, thousands of contracts, month to date, were converting to physical metal. The warehouse data showed it clearly. Metal flowing out of COMEX vaults, moving to private storage, disappearing from the available supply pool. And the CME knew it was a problem. On December 15th, the Chicago Mercantile Exchange raised margin requirements for silver futures. Initial margin for the March 2026 contract increased from $20,000 to $25,000, a 25% hike. 2 weeks later, on December 29th, they did it again. Another adjustment, tightening leverage, forcing traders to put up more cash. This is what exchanges do when they're worried. When volatility spikes, they raise margins. When leverage gets too high, they tighten rules. When the system looks fragile, they pull back exposure. The CME was pulling back hard. But here's what makes this moment different from 1980 and 2011, the last two times silver hit historic peaks before crashing. Back then, margin hikes killed the rally because the underlying supply situation wasn't real. Speculators were driving the price. Leverage was excessive. When exchanges forced deleveraging, the bubble popped. This time, the supply situation is real. China controls 65% of refined silver exports, and they just shut off the tap. COMEX inventories are down 70% from 2020 levels. Physical premiums are 80% above paper prices in major trading hubs. Industrial demand from AI hardware and renewable energy consumed an estimated 60% of total global production in 2025. This is the fifth consecutive year of structural supply deficits, and the backwardation signal is screaming. Silver spot prices are trading above futures prices. This is called backwardation. It's rare. It's dangerous. It means immediate demand for physical metal is so intense that buyers are willing to pay more for silver today than for delivery 6 months from now. Gold markets occasionally go into backwardation during extreme stress. But silver backwardation persisting for weeks? That's a breakdown. Market analysts watch silver lease rates to gauge stress. Normally, lease rates sit at 0.3 to 0.5%. By December 2025, 1-month silver lease rates had exploded above 7%. Think about what that means. To borrow an ounce of silver for 30 days, you're paying 7% annualized. That's desperation. That's a market where physical metal is so scarce that borrowing costs have gone vertical. And then came the index rebalancing. Bloomberg Commodity Index and S&P GSCI, the two major commodity benchmarks, announced their 2026 weightings in December. Silver's allocation in the Bloomberg Index dropped from 8.19% to 3.94%. Goldman Sachs Commodity Index cut silver from 1.23% to 0.65%. Roughly $120 billion is tied to these indices through pension funds and institutional portfolios. When the indices rebalance, the money follows. Passive funds will sell approximately $6 billion of silver futures starting January 8, 2026, to match the new weights. $6 billion of selling pressure hitting a market that's already at multi-year highs, already facing physical shortages, already dealing with 80% premiums in Asia. The timing couldn't be worse. But here's where the Fed's liquidity crisis and the silver market breakdown converge into something bigger. Remember that $74.6 billion repo injection on December 31st? The collateral included $43.1 billion of mortgage-backed securities. Banks were pledging MBS to get cash from the Fed. Why? Because Treasury yields were rising. The 10-year yield hit 4.09% in early December. When yields rise, bond prices fall. When bond prices fall, banks holding those bonds see their asset values decline. When asset values decline, they need more cash to meet regulatory requirements. The Fed ended QT to stop pulling liquidity out of the system, but ending QT doesn't add liquidity back in. It just stops the drain. The $74 billion injection shows what happens when you stop draining, but the system still needs more. The Fed has to start pumping again, and they will. New York Fed President John Williams said it explicitly in December. The adjustment to reserves is not an exact science. The Fed would soon return to a balance sheet expansion phase. Not QT, not stability, expansion, money printing under a different name. Analysts comparing the current situation to September 2019 are right to be nervous. In October 2019, overnight repo rates exploded when the Fed's balance sheet got too small. Within weeks, the Fed announced purchases of Treasury bills worth $60 billion per month. Not QE, they insisted, just technical adjustments. By March 2020, when COVID hit, that technical adjustment became $4 trillion of quantitative easing. Given that the U.S. economy has grown by 40% in nominal terms since 2019, analysts expect the Fed to announce Treasury bill purchases of $80 to $100 billion per month in early 2026. Call it reserve management purchases. Call it balance sheet adjustments. Call it whatever you want. It's money printing, and the timing aligns perfectly with the silver crisis. Think about the mechanism. The Fed buys Treasury bills. That creates new bank reserves. Those reserves flow into the financial system as liquidity. That liquidity searches for returns. In a world where the dollar is losing purchasing power, where Fed balance sheet expansion signals currency debasement, where China is restricting silver exports and COMEX can't deliver physical metal, where do you think that liquidity goes? Into hard assets, into commodities, into anything that can't be printed. Silver is the perfect storm. Industrial demand is inelastic. You can't build an AI chip without it. You can't manufacture a solar panel without it. Supply is restricted. China controls the flow. Inventories are depleted. COMEX is running on fumes. And now, the Fed is about to inject $80 billion per month into the banking system, while the Treasury runs a $1.8 trillion deficit. JPMorgan knows this. That's why they flipped from short to long. That's why they're taking maximum delivery. That's why they're moving physical silver into private storage. They're not betting on a price spike. They're preparing for a market collapse. When COMEX can't deliver, when cash settlement becomes mandatory, when the paper market breaks completely, the only thing that matters is physical metal. And they're taking all of it. The solar industry is already pricing in disaster. Analysts calculate that silver prices above $134 per ounce would wipe out operating profits across the sector. Production would slow. Installations would decline. The green energy transition would stall. But what choice do manufacturers have? Pay $130 for physical silver, or shut down production and wait for COMEX to magically find more metal. They're paying $130. The electric vehicle sector faces the same calculus. Every Tesla, every Rivian, every EV battery system requires silver. Not a lot per vehicle, but multiply it across millions of units, and the demand is massive and inelastic. You can't substitute copper. You can't use aluminum. It has to be silver. So manufacturers will pay whatever it costs. This is what happens when a critical industrial commodity becomes financialized. For 50 years, the global price of silver was discovered in the futures markets of New York and London. The paper price was the real price. Physical premiums were small. Arbitrage kept everything aligned. That system is dead. The current $60 per ounce gap between COMEX and physical markets suggests the era of paper price discovery is over. When buyers in Tokyo are paying $130 while sellers in New York are quoting $72, one of those prices is wrong. And it's not Tokyo. Tokyo has the metal. New York has the contracts. This fits into the broader trend of commodity de-dollarization. BRICS nations and Asian markets are establishing their own physical-backed exchanges. Shanghai Gold Exchange has consistently traded silver at premiums to COMEX throughout 2025. The message is clear. The East doesn't trust Western paper markets anymore. They want physical metal, they want custody, they want control, and China just demonstrated why. By implementing export licensing on January 1st, Beijing showed the world that silver is a strategic resource, not a commodity, not a speculation vehicle, a weapon. Control the supply, control the market, control the market, control the technology, control the technology, control the future. The United States has no answer to this. America doesn't refine silver at scale anymore. The industry moved to China over the past 2 decades because labor was cheaper, environmental regulations were looser, and nobody thought it mattered. Silver was just another commodity. Let China handle the dirty work. Now China handles the supply, and the Fed handles the consequences. Because here's the final piece. The Fed's net income turned positive in December 2025 for the first time in 3 years. From September 2022 to November 2025, the Fed lost money every single month. The interest rates they paid on bank reserves and reverse repos exceeded the yield on the securities they held. They were burning through capital, racking up deferred assets on the balance sheet, operating at a loss. But in December, yields on Fed holdings finally exceeded the rates they were paying out. The Fed started making money again, and that means remittances to the Treasury will resume. Eventually, after the deferred asset account is drawn down. But here's the catch. If the Fed starts expanding the balance sheet again, if they buy $80 billion of Treasury bills per month, if they inject massive liquidity to prevent another December 31st crisis, those purchases will be at current yields, around 4%. 4% is not a lot when you're holding $6.5 trillion in assets. It's especially not a lot when you're paying 3.5% on reserves and reverse repos. The margin is thin, very thin, and if rates rise, if inflation comes back, if the 10-year Treasury yield climbs above 4.5%, the Fed goes back into the red, at which point the Fed will have to choose. Let the system break or print more money. And we already know what they'll choose. They chose on December 31st when they injected $74.6 billion in a single day. They chose on December 1st when they ended QT. They chose in 2019 when repo rates spiked. They chose in 2020 when COVID hit. They chose in 2008 when the financial system collapsed. They always choose to print. The question isn't whether the Fed will expand the balance sheet. The question is how much and how fast. Analysts expecting $80 billion per month might be conservative if liquidity stress continues, if bank reserves keep falling, if the Standing Repo Facility sees more $70 billion days. The Fed might have to move faster. $100 billion per month. $150 billion, whatever it takes. And every dollar they print makes the silver situation worse. Because industrial buyers aren't stupid. They see the Fed ending QT. They see $74 billion in emergency repos. They see China locking down 65% of global supply. They see COMEX inventories collapsing. They see Tokyo paying $130 while New York quotes $72. They know what's coming. So they're buying now, at any price, in any quantity, from any source. They're not speculating. They're securing supply. And when industrial buyers compete with financial speculators for a dwindling pool of physical metal, guess who wins? The guys who need it to keep their factories running. This is the world we're entering, a world where paper prices mean nothing, where COMEX quotes are irrelevant, where the only thing that matters is physical possession, where premiums don't converge back to zero because there's no metal to arbitrage, where the Fed prints money to prevent a banking crisis while commodity markets fracture into physical and paper universes that no longer communicate. The data is undeniable. QT ended because it had to. The $74 billion injection happened because the system was breaking. China implemented export controls because they saw the opportunity. COMEX inventories collapsed because industrial demand is real. Physical premiums exploded because supply can't keep up. And the Fed's response will be to print more money, because that's the only tool they have left. $74.6 billion on December 31st was just the beginning. The Standing Repo Facility will see bigger numbers. The balance sheet will start expanding again. Reserves will be replenished. Liquidity will return to the banking system. And all that newly printed money will flow into a market where China controls the supply, COMEX can't deliver the metal, and Tokyo is paying $130 per ounce. The math doesn't lie. The signal is undeniable. The story isn't over. It's just starting.